corporate finance, the main parts of corporate finance, the ultimate goals are to make better decisions, decision making, and valuation, pricing things accurately, or in both cases, it's sort of trying to objectify things that could be relatively, without finance, be more subjective. Like when people are starting a company, they might say, I think my company's worth $2 million, so I'll send you a quarter of it for $500,000. And it's like, well, how did you come up with that number? Well, I just pulled it out of the air. Everybody at my friend's company sold for that, so that, and every company is different, right? Everything's different. So valuation is key. And how do you know how much to pay for something? If you're going to buy something, if you're going to go buy a company or something like that, you have to have, to merge or something, you have to have an idea of how much that company is worth. And a lot in the markets, there's a whole, you've probably heard of private equity firms, and private equity firms are firms that go and look at the valuations of public companies on the stock market and say, okay, GE is trading at $11 a share, and and it has X amount of shares outstanding, so it's worth $100 billion. And that's really about what it's worth. 10 years ago, or 15 years ago, it was worth $600 billion. They've lost $500 billion worth of value. So you could look at that and say, gee, they have some assets in there, some divisions that are being dragged down by the public markets. And if we bought that company, we could spread it all, sell off the other stuff and capture that value. And we think that if you split it up, all the unbundled value, the latent value in there, we could buy it for $100 billion, and it's really $250 billion. So we'll make $150 billion, boss. Let's buy that company, And so somebody cuts a check and does it. And basically what private equity does is take companies on the public markets that they think are undervalued because, investors that are investing in stocks and things just don't know all the intricacies of the company, and they think they can either run it better or disperse it and unbundle it and make a bunch of money. So that's what private equity does, and that's become very popular in the last 20 years, something like maybe 30 years, where they make these big investment pools and go in and grab those companies, take a big position in it, and then make a tender offer and go and buy it and take it private. Then they don't have to do public financials too, so they don't have to, when you do the public financial statements, you have to disclose all this information about your company, how much it's worth, and what your competitors are, what the risks are in the business, and all those kind of issues. Once you're private, you don't have to disclose any of that to anybody. So it's a competitive advantage, arguably, to be a private company, because when you're a public company, you're much more transparent about what you're doing, and that your competitors can read those things and then figure out ways to compete against you better. So that's valuation to a degree. And decision-making tools, you have to figure out, if I spend $100 on this, is the future cash flows going to be worth $100, more than $100? Am I at least projecting that? Whether or not it's going to happen is going to be how I execute, right? But I have to first know. If you're going to build a power plant, say a nuclear power plant or a whole big solar field, right? And you're going to put up all this stuff, and it's, well, how much is the revenues going to be? How much are people going to pay in electricity each month? How many people are we going to have subscribe? That money's going to feed back, and so then what you do is you net out what it's going to cost you relative to how much you're going to make, and if what you're going to make is more than it costs you, then it's a good deal, right? If you do the numbers and what you're going to make is less than what it's going to cost you, don't do that deal. So that's the essence of the decision-making tools. Anybody have an idea what this decision-making tool might be called? The gold standard decision-making tool of corporate finance? Karen? No? Good. Then, anybody? Because that's going to be good, because now you're going to learn something really, really incredibly valuable for you. Well, I'll put down these letters. And that's a guess. What is it? NPV, it's called net present value. It's basically the present value netted against the costs. This is the gold standard of corporate finance. That is the gold standard tool. And there's another tool that makes some of the decisions a little more intuitive, and that's called IRR, internal rate of return. And we'll talk about both of those. And IRR, interestingly enough, is a tool that was really, for all intents and practical purposes, impossible to use before the advent of spreadsheets. Because IRR, and you'll appreciate this, Karen, is not a formula that you solve for. IRR is an iterative thing where you converge on the right answer. There's no way to solve for it other than run it 10,000 times and then you converge, you go under, over, and then little by little, you converge on the right answer, right? And so before spreadsheets could crank through that in a computer, you couldn't use IRR. You couldn't do it with a slide rule or with, an adding machine or anything like that. So that's a tool that's really brand spanking new, in the last 40 years or whatever, VisiCalc and what's the evolution of the spreadsheet? I think VisiCalc was the first one, and then Lotus for a while. Lotus was the big, you remember Lotus, right? What happened?
Lotus 1, 2, 3. Didn't I just age myself? Because they don't even know what Lotus is.
Lotus 1, 2, 3. Yeah, well, Lotus 1, 2, 3. And it was Mitch Caper was the guy who invented it, and it was really what made spreadsheets. But I think VisiCalc was before that, and suddenly they talk about killer apps, right? Apps that just have so much use that they just become ubiquitous. And spreadsheets became that. And I don't really know the tale of how Microsoft crushed Lotus, but Microsoft became so big that it took over. Netscape was the internet browser. It took that away with Explorer and took away wrested away and maybe because it could package it with a word processor, because it used to be Corel or something. There was all these different choices. It was sort of like Beta and VHS. You had these choices in tapes, and then VHS became the standard. Same thing with all these other programs are jockeying, and now it's just de facto. Microsoft has been for the last 2 decades or so the de facto suite, right, with Word for word processing, Excel for spreadsheets, and PowerPoint for presentations. And that's beginning to change now, though, because Apple, has a niche, but they have their own package like that. Even though I have all Apple products and I love Apple, I have the Microsoft thing embedded in my Apple because I don't want to learn a new program. That's the problem. But one of the beautiful things now is Google has Google Docs. Anybody use that or have that? Google Docs is fantastic, and it's free. It's all free. You can use it from any computer. It's in the cloud, right? So it's not like resident. You can't. It's not like, oh nuts, I left my spreadsheet on my computer at home and now I can't access it. Just go into your Google Docs account and you can take it. And Google Docs is really magnificent for transitioning between different formats. You can put a Word document up and make it into a PDF. You can take a PDF, make it into a Word document. You can make a Word document into an Apple, whatever they call their word processor. And you can switch back and forth between numbers, I think is what Apple calls their spreadsheet. You can make a numbers document into an Excel. Does all of that kind of cross-platform translation for you, which is really incredible. So it's a great tool, and it's free. That's the thing about Google is they make these tool sets free for us, and how can you compete? How can Microsoft compete in a way other than you have to buy it with certain computers? But more and more as we use our computers like we used to do as a terminal and just access the cloud, I think Google has a good opportunity to take that away. But in any case, spreadsheets are the big tool that made corporate finance, these kind of things, and same with NPV. I mean, not to the extent of IRR, but NPV is also, now that we have spreadsheets, much easier to implement and use and make good financial decisions that are transparent. And by transparent, I mean you can share all the hypotheses, all the guesses that go into it with your colleagues and come to a conclusion. Not only colleagues, you can go in and say, here's the present value of my business, and show that to potential investors or something, and say, that's how I say my business is worth $2 million, even though I just started it last week, and that's why I want you to give me $500,000 for 25% of the pie. And they'll say, well, change this number, that number, and negotiate. But at some point you might come to a deal because they understand exactly what your project is. And that's based on financial projections and budgets. And so that's what we'll get into now. I'll back up now and talk about that a little bit. So when you're talking about the numbers side of business, right? We're talking about the numbers side of business. And primarily, it's over time. right? We're talking about businesses operate just like we do and everything else, right, over time. And until we make a time machine, the arrow of time is pretty inexorably this way, right? So, and let's put a time here, right? And we'll call that the perpetual now. This is right now, right? And so then we have the past and we have the future, right? What part of the number side of business deals with the past? I'll give you a hint, it's accounting, right? Accounting is all about what we did last quarter, what we did last month, what we did last year, what we did 2 years ago compared to last year, compared to this year. It's all stuff in the past. And what is the end product of accounting? What are we making in accounting? Reports. Financial statements, right. Financial reports. So it's the financial statements. That's the end product of accounting. That's how we, all of the stuff aggregates up into the financial statements. And what are the financial statements? There's 3 of them. The what? Income statement. Damn, excellent. Balance sheet, boom. Excellent. And what other one? Cash flow. Voila. That's it. And all of the debits and credits and the general ledger and all of that stuff where you're putting in all the invoice and receipts and cutting checks and all that kind of stuff aggregates up into financial statements, into these 3 financial statements. And the reason I set them up like this is because we bookend an income statement with balance sheets. Balance sheets are a picture, a snapshot in time, right? And so what's on a balance sheet? Assets, liabilities, and equity, and this side has to equal this side, right? These 2 things have to balance to the exact penny. And basically what we're using is the equity, and that's basically selling stock or the money that the owners put in and the money the owners have, and liabilities are debts. They might be bonds, they might be obligations of some sort of other. And those 2 things together, just like in life, is what purchases the assets. And the assets are what makes the money in the business. And when you think about this like a house, we've talked about that, right? The asset is the house, right? And the way that you do the price of the house, the valuation of the house, is with an appraisal, right? There's an appraiser that comes and looks at your house, compares it to other sales, recent sales in the neighborhood, and then makes adjustments for whether you have, the amount of bathrooms and bedrooms and the size of the lot and all that kind of stuff, 2-story, 1-story, and then says your house is worth X. The liability, the loan, if for a house, we call it a mortgage, right? And then the equity is the difference between the 2, right? It's called homeowner's equity. So if you have a house that's worth $100,000 and you have a loan on it that's $50,000, so it doesn't get the same number, $60,000, how much equity do you have? 40, yep. Because 40 and 60 have to equal 100. This has to equal that. And this, right, this loan, the mortgage, plus the down payment and how much ever you've paid into principal over time, those 2 numbers finance the asset. That's the same for a business. It's the same thing. If you think about it just like that, you'll never, get confused because that's what it is. And with a business, you have lots of more line items, but basically, just like a house, you could split that up, into the refrigerator and the stove and the sink and the whatever else kind of things, all the different parts of it, but you just call it a house, right? Just like you call it a business. And the same thing here, you have you got to pay the electric bill and you got to pay the this and that. Those are your current assets. And then you have your mortgage payment for the next year. That's the current part of that. Then you have your long-term asset liability. That's the rest of the mortgage. And then you have how much you put in and what the principal is you've contributed to the loan. Same thing in the equity in a business, we call it paid in capital, how much the owners initially put in, and then the other part of it for each year is called retained earnings. So that's a balance sheet. This you'd have one of these at the beginning of the year, let's say. We're just going to use a year as a term. It could be anything, be end of the week, be any of the month, but beginning of the quarter. And the financial markets, right, if you think about the financial markets, that's all companies that are publicly traded, like Microsoft and Facebook and General Motors, all these kind of companies. They report every quarter. They have to report these financials. Once a year, they're audited. The other 3 quarters, they're just compilations that they do in-house, and their accountant signs off of it, but it's not the rigor of an audit. And right now, we're in what they call reporting season, and a bunch of the companies each day now, after the closing bell of the stock exchange, all the investors can get on the horn with them and say, they say, well, we made what we thought we were going to make, our projections, or we've been very under because, whatever happened, we failed in miserable ways or something like that. And then the stock the next day starts to move depending on that. And some big announcements in the last week were Tesla, right? Tesla, the electric car company. There's been lots of people short selling that stock. That means you're betting it's going to go down, that the company's going to go away, it's not going to make it, the guy who's running it is a nut, and all this kind of stuff, and they'll never be able to, making cars is a very difficult business, and only GM and Ford could possibly know how to do that, not some upstart smarty pants from Silicon Valley, kind of thing, right? Everybody's been thinking that way, and so this company's been pounded, and guess what? They made a profit. They made a profit of about $400 million, and they had free cash flow, which is the end of the cash flow statement, of almost $900 million. So they were coming up where they had to pay on some debt, and people were saying if they don't make a profit, then the debt callers are going to, bankrupt the company, liquidate it, and it's all gone. Well, guess what? Now all of a sudden they made it, and now it's like, oh my gosh, all the investment analysts are changing their tune, saying this is a buy. This is really going to make it. Electric cars are good. Fossil fuels are dinosaurs. This is going to be the future, and they have a competitive advantage because they've already put in all these power stations all over the country. Like BMW or Toyota can't just come in and say, here we have a car. Well, great, where do I charge it up? Tesla's done all that work, so it has competitive moats and barriers. So suddenly the stock, beginning of the week, went from like 270 to 350, just like that, and exploded. And now everybody's saying, their target values are 420 and all these other numbers. So, and there's other companies that are, GE today, I didn't look, but General Electric, the one I was telling you that lost all that value, disastrous decade for them. They just really misoperated that company. And they have, and the stock has just gone down and down, and they have a dividend. And the dividend is, let's talk a little bit further on this so we can talk about dividends, right? The income statement is revenue minus expenses equals net income, right? And net income is profit. So for Tesla, they made a profit that is about 300 some odd million. But there's a difference between cash and profit, and that's something that we have to really talk about, cash flow and profit. So when you're doing accrual accounting, right, like we've talked about that matching principle where you match up expenses and revenues at the same time, there are different accounts that aren't cash at the time. You could have expenses that are accounts payable. You recognize that you're going to have to pay it, but you haven't paid it yet. There's also revenues called accounts receivable, where whoever you sold something to acknowledges they have to pay you, but hopefully they will pay you, and you haven't gotten the cash yet, but within 30 or 60 days they're supposed to pay you. So you probably have those kind of issues, right, with deadbeats who don't pay you and stuff like that?
No.
No? Oh, well then you're a very well operated company. And then there's another expense called depreciation, where you put an asset on your books and then you allocate a portion of that charge for that asset over each year for a few years, 5 years or 3 years or 10 years or whatever, so that it matches up more with how long it's going to operate for you. So all of those non-cash events impact your net income. So this could be overstated or understated depending on these numbers. So then what we have is the cash flow statement, and that starts with the net income and then has adjustments for operations. Those are the things I just talked about. And then it has adjustments for investment, right, which is if you buy more assets and things, that's cash going out the door, but you put it on your balance sheet. You don't say, I took it all in that one period, because then you'd have this big loss and you'd use it for 5 years, and then these years would be misallocated with higher profits because you only took it all in that 1 year. And then you have money coming in from financing, whether you got a loan or you sold stock, whatever that is. And then down here is cash. That is the cash number, right? So then you have this next balance sheet here. There you got your assets, your liabilities, and your equity. This number here goes into equity as something called retained earnings. That's the earnings that you retain to help operate the company. The cash flow here goes up. Cash is always the most liquid asset because it's cash. And so you add that to the balance you had here, plus whatever happened during the year, add those together, and that's your cash balance. And the way you reconcile your financial statements is you say, okay, here's these numbers. Does that, when I look at my bank statement, is that the number in the bank statement? And if it isn't, you're in trouble, and you got to go back and figure out what you did wrong. These have to match up. So you have retained earnings, right? So many companies, though, don't put all 100% of their profits back into the company, right? Sometimes, the investors want to take a little off the table. They want a little taste, right? So there's something called a dividend. And a dividend is a portion of that gets dividended out to the shareholders, to the owners, to the investors, right? Because they want to get they don't want the company growing, that's great, but, and I could sell my shares, but I want to have a little bit of an income stream, right? And so General Electric has a dividend now of about almost 5%. That's really huge when you think about trying to get money from your bank account. How much do you get from your checking account? About this much, right? So you can put your money in a GE and get 5%. Well, because they're in such dire straits, today the stock has been tumbling this week because the analysts in the investment community are thinking that GE is going to go get rid of their dividend, and all these people that are counting on that money, and that's why they're buying the stock, are going to be not getting that money. So that could make the stock plunge more. The counter argument is that GE needs that money to restructure the company and make it good again, and then the value of the company will increase, and so it'll make up for that dividend loss. So we'll have to see. And at the closing bell today, when the stock market closed today, they were having their investor call and I don't know what happened, but we can check that out and see, and then see what happens to the stock. So there's all these. So I'm trying to get into some of the financial market stuff that, because we were going to have a course after this that got canceled, and so talk about financial markets a little bit, because it's all interrelated. Those companies and these kind of practices are just what's done on a real super pro scale. And I'd encourage you all to invest in the stock market. It's really a great way. I mean, it's amazing that we can do that we can be owners of Apple, or we can be owners of, Google, or any company, pretty much any company you can, Lululemon, any company you can think of, not every company, but all the public companies, you can become an owner of. And it's become, in economics, the latest theories are, there's a fellow named Picardy, he's a French economist, and he basically went back and looked at economic activity for the last 300 years and basically said that the middle class is an anomaly. And it really only happened in this country after World War II, where the rest of the world was basically decimated from war, and we had intact infrastructure, and we had manufacturing, and we could sell things to the rest of the world. We gave the Marshall Plan billions of dollars to Europe to rebuild, and then what did they do? They turned around and bought our stuff. So it jump-started the economy, and it created all these jobs and a real solid middle class. But that has eroded back to what it's usually been, serfs and aristocrats kind of things, right? The large majority of people just scraping out an existence out of the dirt, and then hyper wealthy people. And we've seen that happen. There's been a lot of, concentration of wealth in the top, they call it the 1% or even less than that. And so that's going away because capital flows more to, money flows more to capital and the investments than it does to labor. That's what's happened, right? There's been this huge, you say, there's been this giant resurgence in the economy since 2008. All the stock market's doing great. It's doubled in value. The companies are doing super. But wages haven't gone up, So the people that labor has not, even though the unemployment rate is under 4%. It's that should be a tight labor market where it's going to bid up wages, but it really hasn't happened. So we could bemoan that fact as a policy problem or society problem, all that. But in the meantime, we should all become, if that's where the money's going, then participate in that stream. Just a thought. So we have these. This is how these are how these all interrelate, right? So that's how accounting works. That's the retrospective part of finance, right? And then you report these things. Either you give them to your bank, or you give them to your investors, or you report them to the public at large, the investment community if you're a public company, all those kind of things. If you're a smart employee, you look at these things and make sure your company is going to be around in 2 or 3 years or 5 years or 10 years, if that's your plan that you want to work there for a long time when you're making those decisions, right? That probably doesn't work that much anymore, because even a guess now with any company, in 3 years, tsunamis of automation and robotics and artificial intelligence are probably going to sweep through just about everything and disrupt companies. So it's really difficult to think about, it's not like the old days, and by that I mean 50 years ago or 70 years ago, where, you could take your lunch pail and graduate high school, march off to the General Motors plant and, work there, and your pappy's working there and your uncle's working there, and you're going to work there for 20 years and get your retirement, There's no secure jobs like that. That paternalistic figure of a corporation is no longer the thing. It's like a jungle out there now. We're all, surviving on our wits. And most people on average, you have 9 careers now during your lifetime. So you have to change. You have to be able to, morph and fit around and do different things, right? So that's why you're here too, right? Is to learn how to. And these are the kind of tools that are used across any business. So whatever business you're in, these tools will serve you well. Okay, so now we've got what's going on in the past, and that's the income statement. The balance sheet is what's happening now, basically, right? So that's the financial statements. Now, let's talk, and we called that accounting. Now we're going to call this corporate finance, right? And this is prospective, right? So what does that mean? It means you're looking into the future, right? Do you think we're more accurate in measuring the past or the future? The past, right? It happened. It's like, what did our checkbook? Well, okay, you wrote those, that's how much we made if sales came in. In the future, what are we going to make in revenues 3 years out? And how much is it going to cost us to do that? It's pretty much, it's what we call this. Ever hear that phrase? Wild ass guess. I mean, that's really what it is. And especially the further out you get, the more of a wag it is, right? Maybe next year you kind of, because you can extrapolate this year and say, okay, we'll try to get 10% more, reduce our cost because now we know how to do better at this or that. But 3 years out, 2 years out, 5 years out, 5 years out, we don't even know what the world's going to look like in 5 years. Autonomous cars, artificial intelligence, where interest rates will be. Will the country still be here? We're getting rid of this nuclear treaty with Russia, and who knows? That might be a quick way out of these climate problems. It's just get rid of the nuclear treaty and let's duke it out. Just kidding. But what I'm trying to say is there's uncertainty out here, right? There's uncertainty. We don't know, or it could be incredible. Things could really. I am an eternal optimist, really, and I think that the productivity tools that we have now just aren't even calculated into the economics of what's going forward. Even when you think about email and power tools like spreadsheets or artificial intelligence and speech recognition and image recognition and facial recognition and robotics and all these kind of things and new materials, just all kinds of incredible things that can make our lives incredibly better. We'll leverage these tools and we may have enough wealth generated from those to spread to everybody and have everybody live super fine lives. And that's really where I hope things are going, that we'll have universal income and a lot of the robots will do the work and all that kind of stuff. And everybody can still follow their great ideas, and that unleashed creativity is going to make things much better. And so we don't know. So it may go up, it may go down. But the one thing I can guarantee you, whatever financial projections you make are going to be wrong. They're not going to be right. Can we agree on that? I mean, it'll be either better or worse, but it's not going to be what you think it is. So, we're talking about financial projections. The way that we do those is we take, have you ever heard the term pro forma? They use the term pro forma with financial projections a lot. And that's Latin for of the form of. And basically because they take the form of financial statements, they're called pro formas, but accurately pro formas don't mean financial projections. That just means the form. And the form that we primarily use when we're doing financial projections is the income statement. And then a lot of guys got smarter now, investors and analysts and things, and they really go through and like Warren Buffett doesn't worry about what the profits are that much. He wants to know what the free cash flow is. What is the cash flow that is not going to have to be allocated to debt service or to investing in more equipment or something? How much of that cash flow is free that can be used productively for stuff in the company? That's the key number. And that evolved over time from net income, and sometimes we call that profit, sometimes we call that earnings. There's something called EBIT that they started to do too after that, when net income was like, wait a minute, net income, they can play with that number. They can fuss with the amortization schedules and the depreciation schedules and all that stuff. EBIT is earnings before interest and taxes. So that was more of a smart number. Then we went to, they even got smarter. I said, wait a minute, we're going to do EBITDA. And EBITDA is earnings before interest, taxes, depreciation, and amortization, because those are things that also were impacting the cash flow. And then they said, forget about all this stuff, just let's focus on free cash flow. And that's where we're at now. That's the number that investors and financial people focus on, is free cash flow. So that's how we got there, basically. That's how we got from here to there. Yeah. So the way we do that, and so we understand that, so each year will be something that looks like this, right? And just for shorthand, I'm just going to do revenues minus expenses equals net income. And then all the plus and add backs, the add backs and the takeaways make the free cash flow, right? And that's the number that we're going to look at. And so what do we look at? We look at time 0 now, and then we look at year 1, 2, 3, 4. Maybe I'll put it over here now just to make it simpler. Not too close together. So let's say 5 years, right? And we're going to have these free cash flow numbers here, right? We could look at net income too, or whatever, because we might not know what we're going to spend on depreciation and all, and we don't have history. The more history you have with a company, then the more you can project with some accuracy based on what you've done in the past. So you have these numbers, right? And this will be year 1, year 2, year 3, year 4, year 5, let's say. And then your company's not going away in year 5, right? Hopefully. It's not like, okay, we're done, we're closing the doors, that's it. There's what we call a terminal value. And the terminal value, we usually calculate that, say in the last year, year 5. Sometimes you only go out 3 years because it's just an acknowledgement that going out 5 years is a little bit presumptuous. It's hard to know what's going on out there. And the terminal value basically takes care of everything else going forward ad infinitum, right, into infinity, as long as the company's going to be around. Companies like Coca-Cola, right, they were founded in like 1886 or something, it's like 150 years old. Companies are around for a long time, right? General Electric, that was, J.P. Morgan and Thomas Edison, way long ago, these companies. Henry Ford. So we don't just think about companies. So we have to figure out how much all these are worth and then pull them back to this time and then pull them back to here. Now I was talking about pulling them back. That's because, you ever hear that phrase, a bird in the hand is worth 2 in the bush, right? What does that mean to you? Birds are good, huh? Birds are cute.
Accept the little. Accept the little things.
Accept little things? Well, what I take it to mean is that a bird in the hand, right, you have it. There might be 2 in the bush, but would you let go of this one and think, I'm going to capture those 2? Oh, then I could have 2 birds. But they might fly away, right? There's uncertainty there that you're actually going to catch those. So the thing that you have is more certain than the prospect of some future action. So that's the same thing with this, right? So say, what would you rather, if I made you a deal, right? So I'll give you $1 today, or I'll give you $1 in 5 years. Which would you take? Why?
Because I know that you're gonna give me now. I don't know.
Yeah, you don't know. I might be gone in 5 years. I might be, traveling to Mars or something. Who knows? Or I might not have the dollar anymore. Whatever. I'll pull my past. Sorry. So there's uncertainty there, right? So the dollar today is worth more than a dollar in the future. And another way that we can say that, a really super famous economist, John Maynard Keynes, he has a whole school of economics named after him, Keynesian economics. Back in the 1930s, and all of our public policy to this day, since the 1930s, since Franklin Roosevelt, has been Keynesian economics. And he had this really astute quote, very insightful, I think, and said that the importance of money is its link between the present and the future. And that's what we're thinking about with finance. Money, the importance of money from a financial perspective is its link between now and the future. And what is that link? What do you think that link is? Okay.
The net present value.
Well, that's exactly where we're going to, is the net present value, and before that, even the present value. If you have and so the link is when you put money in the bank or whatever, say in treasury bills or something, and you're going to get that money back in 5 years or something. What do you get over that amount of time? In a certificate of deposit or something? Interest. That's the link. The link is the interest rate, right? So that's what is the difference between now and in the future with money. And those things are determined in lots of different ways. There's lots of different interest rates. You pay more for a credit card than you do for a car loan or a mortgage, all these different things. Or treasury bills, right? So let's just, to get the math kind of going here, let's say with an interest rate, and now what we're going to talk about is sort of the inverse of present value, and that's called future value. So let's say that you could put your money in the bank, and DM's Bank was having a deal, and you put your money in, and they're going to give you 10% interest, right? There used to be days when they would do that, times, but just to make the math easy, right? So if you put a $1 in, and say in time 0, we're going to say that's today, right? Because year 1 is 1 year out. If you put $1 in today, how much is it going to be worth in 1 year? 110, right? And how did we figure that out? We multiplied the dollar, right, times 1 plus the interest rate, right? Simple. So if this was 5 and this was 1.1, right? 1.1 is the same. 0.1 is the same as 10%, right? Then it would be, whatever 5 is with that. So now, here's the kicker. What happens in year 2? What is it worth? And you can give me the formula if you know, but.
220.
Don't be shy. Well, what we're going to do is we're going to take this number now, right? And take that number and multiply it by 1 plus the interest rate, right? We're not going to, it doesn't go back to this number yet. It's called compound interest, right? So you take the money plus the interest you made in the previous year and multiply it by the interest rate again, right? So that comes out to like 1.21, right? And then what are we going to do in year 3? We're going to do the same thing, right? We're going to take this number, which is really 1 plus I times 1 plus I, right? For the second one, that was the first one, right? Times, again, 1 plus I, right? And so now it's going to be like 134 or something, but 133. It's a lot of decimal points. So on and on, right? And this little thing here is the compounding, and that gets huge over time. It just gets gigantic. Have you ever heard the compound interest tale of, and that's why all of these technologies are going in this exponential direction, because they're doubling so fast. How many chips you can get on a piece of silicon, how quick, cheap things are getting, all that. It's called exponential growth. There's an old tale about we'll say a Persian king, right? And this traveler comes and does a favor for the king that the king just really doesn't. I'll give you anything you want, anything you want. Okay, well, what I want is on a chessboard, I want 1 grain of rice, and I'd love you to double that on each thing in the chessboard. By the time it gets to the 30-second thing of the chessboard, 1 to the 32nd power is more rice than can fill the universe. And so he fakes out the king, in that way. So compound interest, supposedly Einstein said it's, the miracle of the universe. But it really is amazing that it works like that, right? Does that make sense to you?
Yes.
That the money grows over time, right? That $1 today is going to, if you get a certain interest, it's going to grow, right? So now we're going to take the inverse of that. And this is where, and we'll go over this a few times, but this is where you got to get your head around. And this is discounting cash flows. This is what you call DCF. This is the underlying principle of present value. Because what we've been doing is calculating future value, right? We're taking $1 and saying, what's $1 worth in year 3? That's a future value, right? What's $1 worth in year 4? We could calculate it by just putting another one of these things here, right? And by the way, before we go any further, if you start doing this, right, 1 times this element, times that element again, times that element again, times that element again. So in year 4, we're doing that 4 times, right? In year 3, we're doing that 3 times. In year 2, we're doing it 2 times. Can you think of an easier way to write that? How?
Do it, a little squiggy thing.
A little squiggy thing. An exponent,
Yeah,
right?
exponent.
Right. So let's say in year 4, we could do it like this, right? It's that $1 times 1 plus the interest rate, and I'm just keeping the interest rate so it could be whatever, 5%, 6%, 4.835%, whatever, to the 4th power, right? And that's the way to say, do this operation 4 times, chug it through, right? Makes sense, right? That's the hardest math we're going to do. If you got that, you got it all. So here comes the twist, right? If we can calculate future value in this way, how do we calculate present value? How about this? How about if I say, I'm planning on getting $1 in year 4. How much is that worth today with a discount rate of 10%? Instead of an interest rate, we call it a discount rate. How would you figure that out? Well, that's why you're here, right? Because we're going to figure that out now. So now we're going to do a little algebra, right? We did some exponential math. So the formula, I'm going to reduce this to a general formula here, right? The formula for that future value is this, right? The future value is equal to what? The present value, which in this case we're just doing $1, but that number could be any number too, right? The present value times 1 plus the interest rate, and I'm just going to call it n. We can call that exponent anything. But if it's year 3, if it's year 5, we plug in 5 or 3, right? So n equals that, right? And if you're going to do a whole stream of them, what?
I just wrote that when you were explaining. I just wrote that to try to understand the things. I just wrote the formula.
Excellent. Yeah, write the formula, and again, this is in the books and in my other online courses and stuff, and we'll go over this again. This is all new material, so we'll be rehashing this and looking at it from different angles and all. So you understand that's the formula, right?
Yeah.
Make sense? General formula.
In Brazil, so.
Yeah. It's the same thing in Brazil. The present value, it's not denominated in dollars, it's denominated in real.
Yeah.
In real, but the interest rates are always the same, or the concept of interest rates is the same. And the exponents is the same here or on Saturn. It's one of those kind of things. So this is the same kind of thing everywhere. Vietnam too, Iran, Iraq, everywhere. So now here comes the challenge. We want to solve for present value, right? So we're given the future value, right? I said $1 in year 4. We know the interest rate, so we know n is 4, right, in this case. The interest rate is 10%, 0.1. So we know everything, but we want to solve for that. How do we do it? What's the algebra that we have to do to get PV on one side of the equation and get everything else on the other?
Just divide on the future value.
That's exactly it. Think of this, say if we replace this with just an x for now, just to make it just that is that. Then it makes it easy, right? Then we get FV equals PV times x. And then with algebra, all you do is you divide both sides by x, right? And then this is x over x, that's 1, right? That term goes away. And now you have PV equals F, future value over x. And then we know that x, then we just replace x with this, right? 1 plus I to the nth power, right? That's it. You guys can go home. We're done. Your CMA, you got it. It'll be in the mail tomorrow. Does this make sense? This is the key to finance. This is how the world works. This is really how the world works. So future value over this. Oh, I thought it was a question. You're just stretching. Don't do that at an auction. They'll be like, sold to DM for $10 million. Seriously, this is, I know we've stepped through a lot of this, stuff, but it's all about the time value of money. That money has a time value to it, right? And that time value is measured in interest rate, or that usually we call it interest rate for future value kind of things, and discount rate for present value things. We're pulling it back into the present. So when we're thinking about an income-producing asset, whether it's it could be just a machine, or a factory, or a whole company, or whatever. We're thinking about not just 1 year calculating we're going to get some money in year 4. We're going to get money in all these years, right? We're going to get some money in year 1, some money in year 2, some money in year 3, and we're guessing what this money is. Some in year 4, blah, 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 right? So the way that we can add all of those up is there's a sign we use in math, and it's just called the summation sign. So you sum from one side to the other, and it's for the sum of all those ends as well, right? So in year 1, you do it one time, exponent 1, and then in year 2, you do it to exponent 2, year 3, exponent 3, and then you add all those up together, right? We'll get the present value of this, present value of number 2, present value number 3, and then we're going to just add all those together, and that equals the summation of all those, right? And that is the present value. That's the present value of the whole deal. So now you can think about valuation, right? So say if it was a company, say you had a new company, you just started it. You'd never had any revenues, you never had anything. You need $1 million to make your facility or to develop your software or whatever, and then you're going to make, $500,000 a year, and then it's going to go up to $750,000, whatever. And you're going to go and show that if Mr. Investor or Mrs. Investor, you give me $1 million, and here's the stream of cash flows that I'm going to make for you, and that is worth, X amount, and that is 10 times, that present value of that is $10 million. So you give me $1 million, in 5 years, your investment will be worth $10 million. That's the kind of thinking that goes into valuation of companies. Done with every single company, every asset, every purchase that gets made, right? And so now we know how to do present value. The net in NPV is basically just netting out the cost, right? Because you don't get, unless you're really super lucky, people don't throw land income producing assets in your lap, right? You got to pay for them. And you may have to buy them, or you may have to make them, right? So in either case, you can, if you're making it, you estimate the costs. And if you're buying it, you're just going to cut a check, right? But you want to make sure that check is less than what you think the value of the future cash flows are, the present value of the future cash flows. Make sense? So that's what valuation is. And that's what NPV is. And just quickly to talk about IRR. IRR is the internal rate of return. That basically says if it costs me $10 to buy this stream of assets, what's the rate of return? What's the interest rate on these numbers, right? Is it 5%? Is it 3%? Is it 27%? Something like that. And so that's what IRR does, is take the NPV number, which would just be basically, okay, the present value is, $472,833,000, and the costs are going to be, $352 million. So the net is $100 million. that's great, but relative to what? It's just a number, so you don't really have it relative to anything. What IRR does is it makes it more intuitive and say the IRR is 23%. And so, 23%, that makes sense to me. And then you have a way to compare it to others because, But IRR, you don't use IRR by itself because it can be miscalculated a number of ways. It has some anomalies that can make it be the wrong calculation. So you always want to compare. You always want to pair it with an NPV. And basically, what IRR is, you've got this thing here, and you have your NPV, right? And at whatever discount rate, right? The NPV is some kind of number, right? You got your discount rate, and you say, okay, the discount rate we've calculated our weighted average cost of capital. That means how much it costs us to get equity and debt, over here on the balance sheet, is 12%. So that's what we use as our hurdle rate. So with that as our hurdle rate, that's how much it's going to cost us. How much is this thing worth? Well, it's worth $4 million. Okay, great. And that's at our weighted average cost of capital, which is what we call the interest rate for borrowing, for a company. And that varies by how much equity and debt you have and how good of a credit rating you have and all. So then what IRR does is you take this percentage, right? This is percentage and this is the dollar amount, right? And you just keep crushing down these numbers further and further, right, with harder and bigger discount rates until NPV crosses zero. And where NPV crosses zero, that's IRR. I just wanted to show it to you graphically and conceptually because, bless you. You're allergic to IRR.
So how do you calculate it though?
Kind of makes sense. Oh, I'm glad you asked me that. How do you calculate it? You have this stream of numbers that you've figured out in your financial projections, right? Your free cash flows or your net incomes or whatever from what you think the revenues are going to be and what the expenses are going to be and how much money is going to fall to the bottom line. You figure out what your discount rate is, and then you go through and do that. You come up with your NPV. But then basically what we do is you take those numbers, you put that whole stream of numbers into a little formula called IRR that's in Excel, and push the button, and it comes back with the number.
So we don't calculate, Excel does.
And like I said, we can't calculate it. It would take, it runs like 100,000 iterations in a fraction of a second to converge on that number because this is not, IRR is not a formula. What it does is it goes and says, okay, is the number 5%? No, that comes out here. Is the number 27%? No, that gives us an NPV here. Okay, is it here? Is it here? Is it here? Is it here? And then it comes up to that number. So it has to chuck through that calculation over and over and over again. So basically, it's just something that we rely on the voodoo gods of the computer to give us the right answer. That's why you always compare it to an NPV too. And an NPV, there's a formula in Excel that does that, but the way I like to do it is I use that formula, but I also actually, and we'll do that. Does anybody have a computer? Nobody. I can do it on that computer and show you. If you have laptops, bring them, and that way you can make and we'll step through and make it like a template, so you'll have it. And then you'll have that on your computer, and then you can plug in whatever numbers and run these kind of things. So we'll make a financial template if you'd like, and that could be very helpful. And it'll really solidify the understanding. So if you get a chance, bring a computer on. And even if just one of you bring one, we can all do it and then email it to everybody, But try to bring a computer. Is this enough numbers on here? I think so, huh? I'll erase them. I got to tell you, that is basically a whole, MBA year of finance right there. That's really all that you need to know. If you can do this kind of stuff, everything else, nothing else is really that important. You can figure out the other stuff. This is really the key concepts. So with NPV, let's think about net present value. And when you're in a business too, it doesn't matter. It's just a matter of zeros, right? Whether it's a $10 billion project or a $10 project or a $10 million project, right? All the numbers are pretty much the same, right? From a calculation standpoint. So let's say we're going to build a electric plant. And it's going to cost us $10 billion to build that plant. And it's going to take us a whole year to do it, say, right? And we come up with all of the budget of, what we have to do. And this is all basically calculated on that we're on time and on budget, and nothing costs more than it should. And we can actually get the workers and, all that kind of stuff. So that would be what? That would be our costs, right? That would be one whole giant spreadsheet, right, with all the different, and each one of these might be its own spreadsheet adding to a summary line of this kind of stuff. So then if we get that, then we're going to think about, okay, in year one, then we're going to bring it online. So this is year 0, say. And then in year 1, we're going to bring that thing online, and we're going to make $500 million in the first year. And it's going to cost us $250 in whatever, fuel, workers, all that kind of stuff to make it run, right? So we're going to make $250 million that year. And then in this year, it's going to start to go up, and it's going to be good. And then we're going to make $1 million. And we're still going to be able to do, we don't need much more, but we need 300 grand, right? So then it's going to be 700 million that we get. In this year now, we're going to go up to 2 million. And this is going to cost us 400,000. And so this will be 1.6. And in this year, we're going to be really rock and rolling. Now we're going to get up to full capacity, and it's going to cost us that, and this is going to cost us $1 million to run it. And so we're going to make $4 million, and we're going to make $4 million here. And then we think we're going to make something like that all the way going out. Unless we can pay off enough people on the Public Regulatory Commission to up the rates and give us a better deal. But that's what we think we're going to make, right? Is this a good deal to do? Based on these and how sure are we about these numbers, right? Well, we're kind of sure about these numbers, but what happens if out here in year 3, what happens if all of a sudden in beautiful New Mexico, solar panels become super cheap, and they figure out how to make batteries that can store that solar power so that you can have that power to run your refrigerator, microwave, and television at night? Suddenly, you can clip the cord and you don't have to talk to PNM anymore. You don't have to have electricity from the company. These things there's a risk that these might taper off. People might decide, you know what? I'm just going to put that stuff on my roof, have my battery, have my electric car. I'm not going to have any gasoline bills or any electric bills anymore. So there is risk, right? Is what I'm saying. Even in something that's relatively as certain as that, it's been really certain for a long time. And so that's what gets put into how do we calculate the risk of this is the discount rate. So the discount rate starts with what's called a risk-free rate. And what's the risk-free rate? What is the rate that's considered the least risky interest rate in the world?
10%?
The what?
10%?
7%? 6%? Well, it's not actually a rate. It's a rate that varies, actually. It's treasury bonds. U.S. treasuries, right? U.S. treasury bonds are considered the least risky investment in the world because the U.S. government chugging out all this money and stuff, they pay their bills. If they can't pay their bills, we're really in trouble. So that's considered the risk-free rate. And that gets set, that varies, right? You can see that treasury bills are costing a certain amount, right? They cost, they used to be 1%. Now they're up to almost 3%. And people are bidding them up because investors think there's more risk in the world or whatever, that they want a higher interest rate. And the Fed is trying to push up interest rates, and the Fed, the way they do that is buy back money out of the money supply, take money out of the money supply. And how do they do that? By selling treasuries. The way that they bring down interest rates is they buy treasuries and print money, and so there's more money, so more money means it's cheaper, right? So interest rates go down. So that rate is set at auction. That auction rate, every 6 months or 4 months or whatever, the United States gets up and says, okay, we are, the U.S. Treasury says, we are auctioning off $100 billion of U.S. Treasury 10-year notes. Who wants to buy them? And DM stretches like that. Okay, DM, you're going to buy them for 3%. And there's an auction. And different parties, just like on eBay or whatever, they auction for it. And whatever the group that'll pay the most, the highest interest rate, gets those treasury bonds. And so when there's, depending on the appetite for treasuries and things and the supply and demand, that interest rate, the auction, the different governments and different pension funds and things will bid more or less interest. Right now, it looks like interest rates are going to go up because we had a big tax break for the corporate tax break, right? So all the companies got not to pay taxes this year, pretty much. And that helped their bottom line, and then they went and bought back their stock. That helped the stock market, boom. But now, well, those taxes are what pays for all our services, right? So now we don't have that. So what do we have to do? We have to go to our giant credit card called the Treasury bills and sell. We're going to have to sell another 1 trillion Treasury bonds next year to cover the deficit, the shortfall from the tax break. And so that's the supply side, right? We're talking about supply and demand, right? There's demand, there's supply. When these things move, supply is going up. Whoosh. So that means prices are going to go, down, which means that demand is going to go down, interest rates are going to go up. And also demand is going to be lagging by about $500 billion, we're estimating. So between those two things, it's going to put pressure on interest rates to go up. People aren't going to have the appetite to buy them at 3%. They're going to want 5% or whatever. And that's going to then affect the stock market, because then all those time value of money are being calculated. All the profits that everybody expects Apple to have, or Facebook, or Google, or whoever, Netflix into the future, suddenly we're discounting them harder. That brings back that present value to a lower number. So that means that, and the present value is basically the stock price. That means the stocks are going to go down. So look for stocks that don't have big, what they call price earnings ratios, where the price of the stock is, predicated on high growth. Have ones that have low PEs, where they're just looking at, what's going to happen in the next couple of years. You'll be insulated from this coming interest rate increase. And these are just my assumptions, by the way. These are not, obviously I don't know anything, but I'm just sort of speculating like this so you can see the ideas of how people think about financial markets, how people think about companies, how people think about acquiring assets or disposing of assets, right? Or making assets, or green lighting a project or red lighting a project, right? So basically we'd compare the cost to the present value of all these, right? We'd bring all these back to a present value, add them all up, compare them to this cost, right? Minus the costs, and that's the NPV. If the NPV is positive, it's a good deal, right? If the NPV turns out to be a negative number, fire that guy. No, go back to the drawing board and figure out how to, And you can do it a lot of ways. Well, you could just increase these numbers, decrease your discount rate, and say, look, now it looks like a good deal. But that may not be reality, right? You may be just fabricating the numbers to make it look like a good deal. You really need to really spend a lot of time in this future forecasting to understand what's going on with that. Making some sort of sense? So on Thursday, you'll each come to the board and go through this entire thing. Don't worry, I recorded it, so I'll put this up on YouTube too, so you can just watch it sometime. In 2 years, like, what the heck did he say? Just watch it. Is this what you thought it would be like? Finance? It's basically taking the stuff that you do and then guessing about the future, but doing it in an analytical way, because then, you could show this to your boss or whatever and say, you know what, that project we're thinking of doing, don't do it. It's not going to make enough money. It's ridiculous. Put that money into something else. The other project, you might have project A, B, and C. It's like, which one should we do? Because we don't know which one's going to make more money for us. And if you go through this analysis, you might say C is the best one. And here's why, because it's safer, and it's going to, the money's going to be more, and it's going to cost less. There's less risk that way, and whatever it is, you can show and then come up with a really informed decision. And then you also have, what are these? Budgets, basically, right? You can say, are we on track? Are we even on track here with the cost? Oh no, we're running over cost. The costs are really $15 billion. Oh my gosh, we're in trouble. Let's cut our losses, right? We're $7 billion in, let's cut, don't put another $7 billion into it, or whatever. Or, yep, we're right on track, we're actually doing better than we did, so that's my bonus is, this is making more money or something like that. So those are the kind of things that you can actually look at over time. You can bring this to a board of directors, you can bring this to the higher ups and say, here's why we should do X, Y, Z. And you know what, here's a great opportunity. We don't have the money in-house right now. Let's go sell some stock or borrow, talk to our banker and get that money so we can do this and build our company. So when you're thinking about the stock market too, right? When we're thinking about the stock market, every company that's listed on the stock market, pick one, Microsoft, say, IBM, right? IBM just announced it bought Red Hat, which is this Linux software thing, $32 billion, the biggest acquisition IBM ever made. It's going to keep them into the open source software market and stuff. And so now everybody's reevaluating IBM's revenue. $32 billion was the cost. They decided that that's going to add to their bottom line more than $32 billion, right, over time. That's what their management thought. Now the markets are going to, because it's just announced yesterday, the markets will start to decide whether or not they think that's good. And if they think it's good, if IBM stock goes up and they say that's a great deal, or they may say, those people are fools, I'm selling my IBM, and it goes down, right? And so we'll see what the market thinks of those deals. And the way the market decides that is a story for another day, but I'll give it to you really quickly. It's basically that WAG, the wild guesses, right, are basically everybody makes a guess. Nobody knows what's going to happen, how much IBM's going to make, how much it's going to have to expend in costs, and how much it's going to make. But everybody makes guesses on that. And everybody bids, either sells and buys based on their guess. And that's that equilibration between buy and sell. Every stock is an auction all day long. That's why you see the price going like that. Every one of those is a little transaction going on, and the price goes up and down as people say, I'm willing to sell it and I'm willing to buy it, and come to strike a deal. That sets a number, the next number is lower, the next number is whatever. So all of those guesses, everyone's guess added up. No one's guess is right, but there's a thing called the wisdom of crowds that basically says that the aggregate of everybody's guess, experts, non-experts, everybody, falls into a thing called a normal distribution, statistically, and there's a mean to that, the average, right? And here's all these guesses, right? And the guesses kind of populate around a medium thing. This is like so many phenomena in the world do this. It's crazy, but it does. There's a reversion to the mean. Most things go back this way to the mean. And there's some like exceptional ones out here and some really poor ones over here, but this is how it goes. And if you calculate that mean, that average, this number is incredibly accurate. The crowd is much smarter than even the smartest individual in the crowd, which is just, how could that be, right? You have a Nobel laureate that's doing this and stuff. The crowd is smarter, 5,000 longshoremen will be smarter than that, whatever it is, than that guy. And so that's how the stock, so they always say, the efficient markets principle says that all of these changes, everything that happens out here is already priced in the stock because people have had the foresight to see that. And but that really isn't the case, But it's the most accurate way to determine pricing that we know of. Because who knows how much money Google's going to make in 5 years out, and how much they're going to have to pay for that, and how much they're going to make. Well, it's priced into their stock price based on all of these guesses aggregated up into one number of 1,000, whatever the price is for their stock. It's like it's we know that's how it works, but it's like it's magic. You know, it really is. We don't know why. It's pretty cool, huh? So that's how all this stuff ties together. That's how finance ties into the financial markets, and how when you're looking at buying stocks, there's a thing called value investing, where you look at those financial statements, say if this company is well managed, they have a good inventory management system, good operations, you know, good prospects for their revenues, their inventory isn't, you know, expanding too fast, all that kind of stuff, and what are their prospects for the future, and you do all those kind of things and think about that, and then you make your decisions, not just guessing like, I think that stock's hot, I'm going to buy it, you know, or something like that. You actually go into the detail of this, and that's basically what Warren Buffett and all of his disciples and acolytes have done for the last, well, since 1933. That's when, after the Depression, after the stock market collapsed in 1929, Roosevelt made the SEC. All companies had to report their financial statements, audited each year, so everybody could read them and see what was going on. Before that, you didn't have to do that. And that's the next year, a famous professor at Columbia University, a business professor, Benjamin Graham, wrote a book called The Intelligent Investor, saying, here's how you take those financial statements, analyze them, and make good bets on stock. Warren Buffett had to have Ben Graham as a professor, and that's where that all started. The rest is history.